March 2008. Bear Stearns depended on short-term funding to survive. When that funding started to disappear, the firm began running out of time. Its assets had not all vanished, but Bear could not keep them financed long enough to survive the panic. That was the real break. Bear lived on money that had to keep rolling over day after day. As long as lenders and trading partners still trusted the firm, it could stay open. Once that trust started to go, the clock started moving against it. The deeper strain had been building for months. Mortgage pressure had already damaged confidence around Bear, but this did not become fatal until the funding side started to close. That was the constraint. The firm still had positions on paper. What it was losing was the short-term money that kept those positions alive. Then the pressure fed on itself. Lenders pulled back. Trading partners became more defensive. The harder it became for Bear to fund itself, the more the market treated Bear like a firm already near failure. Normal solutions were no longer enough. Management could deny the rumors. It could look for support, but private money was leaving faster than those steps could work. This was no longer a problem Bear could solve inside Bear. That was the switch. The question was no longer whether Bear could calm the market. It was who would take control before Monday. JPMorgan became the buyer, and the Fed helped make the rescue possible. Bear was not saved as an independent firm. It was carried long enough to be sold. The loss of control showed up in the price, too. A firm once worth around $170 a share was being sold for $2. That was the real meaning of Bear Stearns. A leveraged firm can look alive right up until the funding stops. When a firm depends on overnight money to survive, control moves to whoever can keep that money from disappearing before markets reopen.